Market momentum has undoubtedly come to a grinding halt with the massive failure from the buyers on Thursday to do anything meaningful with the overnight move. Some traders are even speculating about a daily double top rejecting the market lower after weak jobless claims last Thursday and what could be a weak non-farm payroll report this Friday. My take is that the base case is still alive and well, and after a 23% rally from the tariff lows, some consolidation is warranted. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame chart now that the May bars have officially closed out. What do we see here in terms of candle structure and location? Solid green-bodied bar with a strong close from the buyers towards the upper third of the range. Hardly any upper or lower wick to read into. That's bullish, of course. On the location front, bar to bar, we've got a substantial higher low as well as a higher high closing completely outside of and above the previous month's range. Buyers go 2 for 2 on the monthly count. But Matt, what about the possibility of the huge double top? Can't you see it? Aren't we going to reject up here, and isn't the market going to crash and burn and go to zero? No, that's not typically how these things work. And I can just show you a number of examples, right? If this was going to be a massive double top, oh my God, we need to short the market right here. How did that work out? Obviously, it didn't work out too well. What about if this was going to turn into a longer term double top? What if we shorted the market right here? How'd that work out? Not so well. The only time we get bearish on the monthly time frame is when we actually trigger the neckline of the double top, which, as we know, we can look back to the Great Financial Crisis. Here's your double top. When and if we make a lower low underneath the neckline, we will be much more concerned. That is when really bad things happen in the market. If we go back to the dot-com bubble bursting, here is your monthly double top. Here is, so to speak, the neckline. You could even draw it somewhere up here. When we're under the neckline, when the monthly chart is making lower lows, that's where really bad things happen. Wave 1, wave 2. So would I just speculatively short the market here, assuming that we have to produce a double top and oh my God, the market's going to go to zero? The answer is absolutely not. The candle structure and location is bullish. We talked about this on the close of the April bar, but the precision off of the previous high from here, as well as if we just zoom out, remember if I do something that looks like this, we'll bring in a trend line from the sickness low, doing something along these lines. This April higher low is over the trend line. It's over this previous high here. It's confluence with the monthly 50 SMA. I don't really see a reason to be bearish on the higher time frame monthly. This was a, what do they say, generational buying opportunity at the lows of the April bar. And we've seen follow through so far in the upward direction outside of April's range, not even testing the lower wick and closing firmly over the April range. So let's drop it down to the weekly time scale. And what do we see from this perspective? Same thing, candle structure and location. Here we go. Structure is a little bit more indecisive. I would call this more of a hammer-esque / doji bar on the weekly time scale. It's got a green-bodied bar, so the closing print is still technically over the opening print, but we do have some indecision towards the upper wick and a little bit more indecision towards the lower wick. The lower wick is slightly larger than the candle body and the upper wick, so I would give the buyers the benefit of the doubt here in terms of structure. If we're thinking about candle location on the bar-to-bar count, notice that we have an inside bar, so a classic lower high and a higher low. This is exactly what we talked about actually in last week's episode of the weekend analysis, right? We were saying if the market just consolidates in here, it's honestly not the worst thing in the world, because what's the overall weekly trend? Well, we know that we have the major capitulation low. This is a daily firm higher low, weekly soft higher low, and from here to here, the biggest sort of change in the market was the weekly higher high. So it's no longer fair to say that the weekly trend is down. This consolidation is happening in a weekly uptrend. And as I've been saying, and as many people have been saying, I'm not, claiming this to be a unique opinion, but if the market comes in and closes the weekly gap, I'm still bullish on the weekly time frame. This isn't a huge opportunity for a weekly higher low over this previous pivot high. So we could close that gap. We could test the weekly 50 SMA. And I'm not overly concerned. To give you an idea of that level, it's around 570.44. The daily gap closes a little bit underneath that level. And if you've been tuning into the channel, this one maybe is a little bit more unique in terms of my opinion. but I would still remain a bull on the weekly time frame so long as we're over this. Let me grab the pointer. This previous pivot low, which is around that 550, 551. Why would that be the case? Because this is still a weekly higher low. Now, it brings in complications if we do support here for the possibility of then some kind of rejection here, and now all of a sudden the weekly trend becomes neutral. That is a possibility. But in an overall uptrend, my base case would look something along these lines and then follow through to the all-time high. But this is very speculative. Let's not go there for now. As of right now, the weekly structure, the weekly location, suggests that momentum is slowing down after, as we've mentioned in the intro, a nearly 24% rally from point A to point B. Some digestion of the move is well warranted. The next thing I would point out on the weekly timescale is actually if this double top here has a neckline here, where is the consolidation taking place? Above or below the neckline? Is it bullish? Is it bearish? I mean, those are sort of rhetorical questions. It's above the neckline, and I would argue it is more bullish than it is bearish. If we bring out the Fibonacci's to take a couple more measurements here, let's come in from the low of the move up to the top of the move. This is not even close to a Fib 38.2 pullback. This is high and tight consolidation. If we were to break out of this consolidation, sorry for the odd zoom, I would have to imagine that the target is just simply the all-time high. That's a range double. On the weekly timescale, there you have it, right? The measured move of a consolidation range like this is a range double. So all-time high could be in the sights, honestly, sooner rather than later. The next thing I'll do is come in from the previous all-time high down to the low of the move and just reinforce as well that we're well above the Fib 61.8. So is there anything really bearish from any of these measurements? I'm not seeing it. If we come in with the anchored VWAPs on the higher time frame weekly, we're above the entirety of the cluster, which also strikes me as bullish. And we can finish up the weekly analysis here with our volume profile. If I just zoom out on this a little bit, you'll be able to see that we are well above this high volume node. That represents the gap fill reversal on the weekly time frame. Remember that this is kind of a cluster. We're treating these as clusters, right? There's a cluster, here's a cluster, here's a cluster here. So we're in the upper cluster of everything that's recently been traded. And if I actually expand this off to the left, notice that the lower wick of last week's bar keeps us inside of this upper cluster. So it's not like the market's attempting to break down and rotate through the low volume void. Even if it did, as we've just mentioned on the weekly timescale, from a trend counting perspective, I don't really see any issues with a move to close the gap on the weekly closer to that 570 mark, as we were just saying. So the base case lives on. I'm totally on the side of the buyers on the higher time frames. We can get more nuanced on the smaller time frames, but here it's just up, and away, and some consolidation once again after a 24% rally. Well warranted for the market. Let's drop it on down to the daily time scale and see what else we can learn about the market here. Let's begin with our weekly expected move. It's this gray shaded area right here between the cyan lines. If you're not familiar with the weekly expected move, check out the video tutorial in the top right hand corner. The upper bound is right around $600.03. That would imply a breakout of this most recent range, the weekly range we were just referencing. If we're contained by the lower bound, the number's at 578.75, and that would imply an equal low to the weekly range that we're talking about as well. It's confluent still with the 200 SMA, the green moving average on the screen. Let me clear this up so you can see it. There's the 200 slowly creeping higher. I'll even zoom in. I do want to zoom out though for a second and reference some previous price action as well. So we'll get to that. But lower edge, confluence here, 200 SMA slowly creeping higher, top end of the China gap, which remains somewhat unfilled. Generally speaking, expected move does strike me as being more bullish for these reasons. Equal lows, higher highs. It's bullish in an overall uptrend, right? Now, on the daily time scale, you're starting to hear, just like maybe on the monthly, some big, bold calls that, oh my God, this is a double top and the market's got to crash and burn and go to zero. I would just ask you to pause there for a second and take the same approach as what we talked about on the monthly, which is that if this is going to act as a daily trend reversal, you need to be respectful of that neckline. Yes, there might, in hindsight, end up being some kind of lower high here, very nuanced, but a lower high for the lower high double top. But where do I actually get bearish on this move? It has to be under the neckline, which inherently is under the lower edge of the weekly expected move, but more importantly, moving into the gap fill from the China move. So is it reasonable to maybe short the market underneath 577 for some gap close down towards 567.75? I think the answer is yes. The daily trend would be changing via the lower low underneath the neckline. However, like we just talked about on the higher time frame weekly charts, would I really be overstaying my welcome on the bear side at 567.75 here? Probably not. If the daily chart were to develop in some sort of move that looks like this, I'm still very, very interested in the possibility of a gap fill reversal over the China gap close, which is here at, once again, 567.75. You get a weekly higher low, and then on the daily chart, you probably just become more confident in this move if we get some sort of Brigade bolt back over 577, if we can recapture the neckline of this move. That would also be a recovery if this were to take place. You would overshoot the daily 200 SMA, the green moving average here, then reclaim it on this 577 higher low. So I would certainly be bullish in this sequence that you see here. I think on the daily time scale, until proven otherwise in this box, we're really just taking the market one step at a time. If you look at the price action of last week, very, very indecisive, couple steps forward here, pulling back intraday, a little bit of drawdown on that Friday session, only to close back higher inside and above this 588.25 level. You're not really seeing a lot of confidence in the market right now. It was a shortened holiday week. We're headed into summer trading months. You have all of this sort of coming to a head here. I think one of the mantras that comes to mind for me is you should never really just short a dull market because you think it needs to do something, right? That's a classic recipe for disaster. So on the daily timescale, the trend is up. We've talked about how and if this double top is going to play out. It's really not that bearish, and we're still giving the weekly chart the benefit of the doubt at 567.75. Now, one of the reasons why I'm maybe hyper-focused on this possibility as something to at least talk about first, we'll talk about upside in just a second, is because if we look back and remember the V-shaped recovery here from, this was the yen carry trade explosion, correct? Recall that this to this was a higher high. So you're sort of getting that. I'm just going to bring this up as a parallel. It doesn't have to play out the same exact way. But you have your higher high, you have your higher high. You get your distribution, the market's sort of like, okay, we've seen a substantial rally off the lows, now momentum sort of drying up, right? When you break that, you pull back, you overshoot. In this case, it's the daily 50 SMA, the blue moving average. Notice how it could be very similar here. If this is your distribution, the market needs to pull back for a more firm weekly higher low at that point. You could overshoot the daily 200, support the China gap fill reversal, and get something that looks like this, right? And once again, where would you maybe be a little bit more confident on the higher low reclaim back over 577? So just as a little parallel, that could be a, again, not exact, it doesn't have to repeat in the exact same sequence, but wouldn't be unreasonable that if the market breaks down from this range, that's kind of what we're looking at in terms of recovery and how you would count the trend sequence, right? We're still dealing with the opportunity for a major higher low at that zone. But what about the upside? Are we totally at a standstill in terms of overhead resistance? Is it impossible for the market to move higher? We do have this overhead supply, and what I've done is actually extend this off to the left. If you drill on down to the hourly time scale, let's actually just do it together so I can show you this with a little bit more nuance on the hourly, and then we'll jump into the hourly, sort of how the days shaped up last week, right? So the overhead supply level really has been labeled as this 588. That's what we've been using over the last little bit. But if you want to encapsulate these previous lows, it's right on point with the top end of the move that we've seen recently. If I just scroll the recent history, right, there's that same level, this 595.15. So is it possible that we're running into this roadblock and the market's stalling out as it's trying to push into the overhead supply? It is possible, but one of the things I would just reinforce is it's more of a market stall out. It's not that brand new money sellers, strong momentum-driven sellers are stepping up in this market. And we can really just sort of display this by analyzing the price action on the hourly over the last week's worth of trade. So on the Tuesday open, we actually opened, obviously on the gap up, but underneath this well-defined level on the S&P hourly, and primarily coming from prior trade that was happening here. This could be viewed as trapped overhead supply. The market had no issue on Tuesday rallying through that, closing above. Obviously on the Wednesday session, most of the consolidation was above as well. Thursday, we did have that big failure from the buyers to get continuation in the upward direction, but notice on the Thursday session, as we poke underneath the 588.25, the market rallies to recover. Then notice what happens on the Friday session. The market drives to the downside. It tests a little bit of this Tuesday morning gap up. And then where do we close? Right back over the 588.25. So as I'm thinking about who is participating in this market, it's not that we have strong new money buyers who are like, okay, let's just keep the momentum train going in the upward direction. They're not really here, but you don't have new money sellers. To me, it might be some profit taking as we come into, once again, as we said on the weekly, a nearly 24% move off the lows in nearly a straight line after the tariffs were sort of resolved. I think this is profit taking. It's not new money selling. We can see that as evident by the actions of buyers and sellers intraday here, primarily Thursday and Friday, just unable to really yield stronger price action to the downside. Put yourself in the shoes of a seller, right? You open up on this Friday morning session and you're like, okay, the jobless claims came in a little bit weak the previous session. On Friday, we had PCE in the morning session. There was also that tweet from Donald Trump about sort of reinstigating China tensions, if you will. That didn't allow in the first lower wick a lower high underneath 588. Intraday, consumer sentiment revision sent the market back higher. Sellers tried again to push markets lower, but what would they have ideally liked to see happen? Some kind of lower high under the 588.25 coming from here, and it just didn't take place. So as I can, continuously look at the price action, talk about it here with you, it doesn't seem to me that stronger sellers are really stepping up. And we'll see this at the exchange level via the internals in just a second as well. The last thing I'll do here is go back to the daily time scale, and I'll just come in with a support trend line off the lows. And what you'll notice here is here's your capitulation low. There's your first major higher low. The pullback here is sort of near the trend line. The low of the Friday session is near the trend line. I don't really think, you guys know me, I'm not a huge fan of trend lines, but I don't think there's a reason to be bearish. Even if you wanted to get bearish before the break of the daily double top neckline and say like, okay, now I'm finally bearish after the break has happened, you're over the trend line. I don't see any real excuse for major bearish actions here in the market until some of those reference points start to deteriorate in a more substantial manner. Now, in the upward direction, should we break the 595.15, I think it's very clear that you're just looking at this set of lower highs here around the upper edge of the weekly expected move. It's 599.25 technically. Beyond that, this is another range here where, in theory, the weekly range double brings you to the all-time high, and there's some pretty thin structure on the breakdown. Let's go back to the hourly and maybe auto zoom out to see this. There's some reference points here, and there's some reference points here, previous support, some of this stuff from off to the left, but the hourly structure is pretty thin on the breakdown there. So over that 599.25, yeah, you've got the 602.50s, you've got 606.75, but all-time high, I'm not making the claim that it has to be here this week, but there's not a lot in terms of major overhead resistance that needs to be battled through if we can accept over the 599.25. So there's absolutely some work that needs to be done from the buyers. Let's get a little bit more granular here in terms of the pathing, and then we'll jump on with our internals analysis. If we open over this 588.25, I think the buyers open in control for the week. And I would be looking for Brigade bolts here. This is like an intraday scalp, right? From 592 into 595.15. The stronger buyers really step up when and if we bring in a daily higher high via the break of 595.15. If we get over that, it's rock and roll to the 599.25 level we just talked about, upper edge of the weekly expected move. If we pull back, the next phase of consolidation, right? If this is a building block, the next phase of consolidation ideally stays over the 595.15. If we're counting the hourly trend, we have lows, higher lows. This is kind of a shelf of lows, really more so equal lows. Overshoot is maybe a lower low if you want to get nitpicky with me. You kind of have highs, equal highs, maybe a lower high. So the hourly trend is definitely neutral through last week's trading session. The hourly trend flips to up if we were to break out of this in the upward direction, reinforcing the idea that we are still in an uptrend across the board. So 595.15 on recoveries over it, looking for that follow through 599.25. Things really open up for some more free air, so to speak, over 599.25 for all the reasons we just described, closer towards the all-time high at 613. So that's on an open on Monday morning over 588.25. Open here, Brigade bolt here. This is a scalp intraday. The best trades, right? So you could really just block this off and say, okay, any consolidation here is still technically bullish, but the best trades look something like this, right? Clearing this previous shelf of resistance at 595.15. If the market opens under 588.25, somewhere in here, I would give the market the benefit of the doubt, trying for a full gap fill reversal. I would look to see if there's a long opportunity here. If you can't find it here, if there's no clear way to manage risk up against 581.50 on the gap fill reversal, I wouldn't necessarily be bullish if you can't grab that entry. I'd be neutral through here and then be bullish back on the Brigade bolt over 588.25, looking for maybe an outcome along these lines, something for risk and reward like this. And then, of course, ballooning runners trying to do risk reward like that over 595.15, 599.25. That's kind of the upside. But once again, in here, a little bit more reserved on the market, not really pushing the bet. It's this higher low that gets me interested in the long side again. If we were to really reject this, so again, here's the open sub 588.25. We close the gap, reject here on a clear, inverted hammer on the 15-minute chart, hourly chart, double top on the 5-minute chart, head and shoulders on the 5 or 2-minute time frame chart. Maybe some kind of rejection there, plays back down to the equal low, but I would be really cautious about that. Reason being is we know the daily trend is still up, we know the weekly trend is still up, we know the monthly trend, for just the sake of going through all the time frames, is still up. Why would you try to fight this inside of a balance range and get aggressively short? It just doesn't make the most logical sense. So it would have to be a no-brainer short setup with complete confluence out of the broad market internals if that's a trade I'm going to entertain. Why? For all the reasons we've described, right? Who's getting paid in this market? Well, aggressive sellers who short the lows on these breakdowns of levels aren't really getting paid. Longs are kind of hanging in there, but we don't have momentum sellers. So it would take quite a bit for me to be overly convinced that a short setup there is a good idea. Of course, that just leaves us with, if the market does open sub 588.25, maybe gets consolidation here, that's where I would start preparing for, okay, what are the odds ultimately that we do break the neckline, Brigade bolt into the gap, and this is a very lucrative range to trade, right? Because obviously there's thin structure there, under 577, 566.75, everything we just talked about from the daily time scale. So that's where my head's at in the S&P 500. We'll quickly throw on the intraday anchored view apps. Once again, this is just totally supportive of the key level we've identified so far at 588.25. I think that level speaks magnitudes with all of the anchored view apps from the major China gap up, the top of the move, as well as the Friday gap down from, if you remember, this was EU tariffs, right? Then the 50% EU tariffs taken back and all sorts of nonsense. But 588.25, it's the key level. If we're above it, I would maintain a short-term bullish stance looking for that upside break. Remember, in uptrends, equal highs offer breakouts rather than double tops, as we've illustrated on the monthly. And if the price does open below 588.25, we're cautious, probably more neutral, and then underneath this anchored view app at the full gap close, if there is no gap fill reversal, if this doesn't happen, if we get straight shot through and consolidation here, that's where we're more bearish, under 581.50. There's really no sense in throwing a Fibonacci on this range. I mean, if you really wanted to, we can. Let's just do it for the sake of maybe being congruent. 38.2 is right at the 588 level. 61.8 is kind of in no man's land. The more time we spend above the Fib 38.2, the higher likelihood that this is seen as bullish consolidation. So that is your spiders analysis. That's the pathing. Let's take a look at the market internals for the NYSE side of the exchange. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see? I think primarily the question we always ask and answer is still in play. Who was in control at the exchange level? The market did what last week? It really went more so sideways than anything else. So who has the burden of proof in an uptrend? Well, if the trend is going to change, then the bears have the burden of proof. Well, Tuesday, big, solid inflows to the session. You can see some mild outflows on Wednesday. Thursday's pretty flat. Friday's pretty flat. Net flows on the week, not substantial, but still positive. You can see that in here. If you take a look at the advanced decline line, strong trend higher zone and big correlation on Tuesday. Wednesday, pullback, not in trend lower zone. Thursday's over the zero mark. Friday works its way to the zero mark. Any big bears stepping up there? I'm not really seeing it. The index score absolutely is weak on the Wednesday, Thursday, Friday sessions, and I think for good reason, as the market was technically moving lower intraday there. But at the exchange level, not really seeing major deterioration. Now, we could do the final, which is the cumulative build out of the tick. Nice 45-degree line on Tuesday. Wednesday, it is a 45-degree, but it's not really that substantial. Thursday's technically flat, as is Friday. Do the bears, who have the burden of proof, really seem to be exhibiting much strength at the exchange level? To me, the answer is no, and for that reason, I maintain that the market context here is more supportive of the bullish base case, bullish consolidation in an uptrend after a substantial rally. Let's take a look at the market profile. If you're not familiar with this dashboard, take a look at the video tutorial in the top right-hand corner. It's more of a chart type, not a dashboard. You can see here that value is pretty unchanged through the week, right? Here's Tuesday. Here is Wednesday, Thursday, and of course Friday, unchanged as well. So even though there was that foray, if you will, to the downside, that breakdown, it swept a number of days lows, right? It even swept the Tuesday low. There you go. Where was value? Value didn't really progress lower with price. It remained higher in the session, and point of control was higher as well. So are market participants really like running for the exit signs and selling everything down here, committing a lot of volume? The answer to me is absolutely not. One thing that maybe we should spend a little bit more time on now that it's very blatant and obvious. This is the court action, of course, that blocked some of the tariffs. The tariffs got reinstated. You've got to be like nimble on your toes if you're keeping up with all the tariff headline drama. It would, to me, just suggest, again, that there's not really momentum buyers entering the market either. But in the uptrend, once again, the burden of proof still remains on the sellers here if the trend is going to change. We can get profit taking, we get sideways consolidation. That's not really going to change the trend until those stronger sellers step up, given that we have a daily higher low, we have the hourly uptrend trying to stay over that 588.25 level, the weekly uptrend, monthly uptrend. The internals are supportive of just profit taking, not really new aggressive sellers. So in my view, this is not the most bearish thing that it could be. What would be more concerning is if on Friday, when we swept these lows, after this failure in the Thursday overnight session, the market closed massively lower. Big point of control lower, value lower. Just didn't happen, right? Value, as we just walked through, is pretty much unchanged on the week. So that's your S&P analysis. Let's jump on over to our good friend, the nasty NASDAQ, on the monthly time scale. Let's start there as well, and let's keep it going. So QQQ monthly time frame chart, it's a rinse and repeat. Basically, this is the SPY. Let's go to the Qs. It's a rinse and repeat of the S&P analysis for the most part. I mean, you get a majority of people making the same argument. Here's your double top. It's got to crash and burn. Well, I mean, why was this not a double top? Why didn't the market go to zero here? Probably because the market is in an uptrend. You have all the same confluence basically. Here is your nice higher low over the monthly 50 SMA. In terms of candle structure and location, you're over the April highs. Clean breakaway to the upside, closes strong. Higher high, higher low. There's not much to really read into on the bear side. This is a bullish monthly time frame chart. As we drop it on down to the weekly time scale, you can see a similar picture here. The only concern about the NASDAQ is that we did technically breach, right? Let's center ourselves. Let's get back to candle structure and location as we typically do. What do we see in terms of candle structure and location? Much more of an inverted hammer instead of a doji/hammer-esque bar like the S&P 500. So that already starts to lean a little bit more bearish, where in the upper wick there was clearly some response from the sellers, pushing prices lower towards the midpoint of the weekly range, but this is still a green-bodied bar, so we close over the opening print. Sellers really didn't have what it takes to completely reverse the trend, but sort of the next warning shot across the bow is if we start thinking about the bar-to-bar count, we do have a higher low as well as a higher high. Remember, the S&P was an inside bar, pure play consolidation, whereas the NASDAQ technically looked over the previous week's high and failed with a closure back inside of this range here. Now, I'm not going to say that this is, oh my God, the market needs to crash and go to zero, but it wouldn't be unreasonable perhaps if this is a balance range, right? Look above and fail typically targets the opposing end of the balance, which would be closer to on the weekly timescale, something around the 501. Now, notice that if we're just taking a step back now, instead of the bar-to-bar count and analyzing the overall trend, you could still do the same thing that we talked about in the S&P 500. If this is the weekly double top that caused the pain, here's your lower high, there's the big capitulation move. The rotation to the bottom end of the recent and local balance here is really just still consolidation over the neckline of the double top. Even if we were to close the gap, we all know that that could still yield a weekly higher low also, and then we're probably bullish on the daily time scale on a higher low acceptance back inside of this balance range here. If the market just totally goes sideways inside of the range, let's just say that we tag the lows, go sideways, whatever, a balance range breakout, leaving this gap unfilled, has to be carried forward as a bullish indication. Why? Because there's no structure there. Literally on the weekly time scale, there's no structure there. You could see the gap. There's no price action that traded in that move. So sellers should have no problem closing that gap. If it doesn't close, it tells us that stronger sellers are not active in the market, and therefore any breaks of the balance range with acceptance this time around should easily start to target the all-time high in the NASDAQ. So very similar analysis to the S&P 500 with the one caveat that you are getting a little bit more of a look above and fail out of the QQQ weekly. If we come in here with our anchored VWAPs on the weekly time scale above the entirety of the cluster here, we can come in with the Fibonacci's from the bottom up to the top, still over the Fib 38.2, no issue on that. And yet again, more candle closes on the weekly time scale over the Fib 61.8, dramatically increasing the odds that we should see a 100% retracement at some point. If we come in with the volume profile to remain congruent in our analysis, what do we see here? We know that it was really just one high volume node well above that, and if we do something that looks like this, we've still technically closed over the highest volume node of this cluster, if you will, before the low volume void into the next one. So not really seeing an overwhelming amount of data or evidence here that suggests, once again, stronger sellers, big bearish activity. Oh my God, markets should be crashing and going to zero. It's just not the case. If we take a look at let's go to the daily time scale now, back to the QQQ. Weekly expected move is up first, as it always is. What do we see here? We've got 530.71 if contained by the upper bound, and at the lower bound, we've got 507.51. That, of course, would imply a slightly higher high, as well as equal lows to the bottom end of the balance range that's forming in here. It's really the Thursday gap up that causes the look above and fail on the weekly time frame, that upper wick, right? Which we will dive into on the hourly chart in just a second. The thing I want to point out before we get there is the relative strength, though, as a matter of fact, out of the QQQ NASDAQ, which of course is coming from the sustained hold of the bottom end of this overhead supply here, which is much closer to the 509 level. As long as the NASDAQ is supporting over 509, I really don't, again, see any argument that would suggest stronger sellers are stepping up and, oh my God, we've got to be concerned about the China gap and, the market's going to panic and go to zero. I'm not seeing it. Even if we were, once again, to call this some kind of daily double top, I noticed that the neckline isn't even at the China gap. So that 509, that neckline of the pattern in here, it's really going to be the arbiter of price. Lower edge of the weekly expected move, it's all there around that 509 zone. If we're over that on the QQQ, I think it would be a disservice to yourself and your trading, your investments, however you use this analysis. It would be a disservice to maintain any sort of major bearish stance on the market. Now, if we were to get underneath that, I think we start playing cautiously. And then for me, the biggest trade opportunity here is still just the China gap. I mean, if we get underneath 501.50, a rotation to 590.50, I'm all about trading shorts through that 10-point range, 11-point range, whatever it might be in there, into the daily 200, getting that test. But that's if we get there. And once again, you have to break through that line in the sand first at 509. The reason I'm leaving this chart zoomed out is so you can continue to see that, right? It is very important that you visualize that you're getting acceptance inside of this range instead of, right, the market in a more bearish sense would have came into it, rejected the bottom end of the range, closed the China gap. Oh my God, we're back underneath the weekly high, right? This here. This is a failure. This is a daily lower high. And oh my God, the trend is reversed and the market's going to zero. Are we getting this? The answer to me is no on the sustained hold over that 509. So that's the importance of the daily time scale on the NASDAQ. If you come in here with that trend line, right, you can see the same thing. You're over the support trend line. I'm not a fan of trend lines, the diagonals. I much prefer the horizontals. But even if you want to use it, there's no excuse to be a major bear here. If we take a look at the hourly time scale, this is where we can break things down a little bit more so in terms of that nuanced failure here. I've got to concede the point, right? It would be irresponsible to not talk about the massive failure from specifically the buyers in the NASDAQ. The S&P had a little bit more leeway because it didn't make a new pivot high, right, over its previous highs. But the NASDAQ absolutely did on this gap up on Thursday morning. The fact that there was no gap fill reversal over 522.50 is a red flag. White flag, warning sign, whatever you want to call it. The fact that the market came back down into the balance here, it just tells me that, once again, we do not have momentum buyers ready to step up and buy this market. One of the things the market could be waiting for is more clarity from the Fed, or at least the perception of more clarity from the Fed, which in my view comes this Friday via the labor report. We get the full Monty, we get the non-farm payrolls, the unemployment rate, as well as average hourly earnings, right? So that'll be a big watch. If the number is soft, we are expecting a Fed to start reacting sooner rather than later, and a more dovish Fed could drive prices higher with lower rates. It's very critical that we continue to watch the inflation metrics with this as well. Obviously, on Friday, we got PCE. Not a shock, it came in light. And so far, if the Fed is correct about inflation remaining transitory on the tariffs, right, then I think that the labor market holds the key for really what we're watching for next. And if you recall, in some of their conferences, they've explicitly said, when the labor market deteriorates, we are willing to bring rates lower, basically. Is if you read between the lines, typically what they do, they said, look back to, 2023, when they started to lower rates by the first amount. They're willing to lower rates by 500 basis points. Obviously, that's not what happened in 23. That's not the point, or 24, was it? Getting my timing mixed up here on the years, but you understand. The most recent cuts from the Fed were not 500 basis points, but they responded when there was an uptick in unemployment that they were not willing to let continue. That was a long-winded way of saying we don't really have new money buyers who are confident in the market. We can see that in the price action, but we then inverse the question and we say, okay, if buyers aren't getting strong here, does it make sense to get short? And when I ask that question, the answer continues to remain no. We're in a daily uptrend. I mean, technically speaking, this is a higher high in the trend count. It was not really successful. We didn't confirm a higher low outside of the range. However, on the hourly time scale, notice, just like we talked about in the S&P 500, on the Friday session, the market makes a foray underneath the Tuesday low. It actually closes the gap all the way to the previous Friday's high. Buyers do exactly what they should do. They go gap fill reversal, and instead of the sellers being able to get some sort of lower high rejection here, oh my God, the trend is changing, where do the buyers close on Friday? Back inside of this balance range here. So as I flip the question on its head, yes, we don't have momentum buyers here, but we also don't have momentum sellers. If they were here, this lower high underneath the range at 515 would have been a must accomplish, and it just didn't happen. So what's the game plan for the NASDAQ as we head into the week? Be my guest if you want to trade in the meat grinder here. I think the most responsible and patient trades are waiting for this, and then there's room to run in the upward direction. Higher lows over 522.50, Brigade bolt here. If we get a Brigade bolt to the downside, I'm cautious. And then probably on a break of last week's low, that's where I start to lean into the bearish outcomes a little bit more so. I would think a break of that Friday low brings us into this level, and then I would reevaluate here. I would absolutely reevaluate based on everything we just discussed on the daily time scale at 509. Because why would you be short into a known area of support, which is previously, I should say, the bottom end of the overhead supply that's been holding fairly strong over the last couple of sessions, right? So that's that. Where do the real bears step in? I would think underneath 509, this consolidation here, a mirror image of what we talked about on the daily, right? And then this is the trade that I would be more interested in being short for, I should say, under 501.50 into 490.50. Let's quickly throw on the intraday anchored VWAPs. You can see here, the midpoint of the range, the Thursday highs here really is what defined this at 517.50. It's acted as a key level, and the anchored VWAPs are stacked there. I would give the buyers the benefit of the doubt early on in the week. If we're getting consolidation here and then do something that looked like this, I would be much more optimistic about that follow through versus maybe a breakdown and overshoot at the lows, sloppy in here. I might sort of not second guess, but I would think twice. I would look for market context to determine if that's a trade that we should entertain if there's not great consolidation on the hourly over 517.50 in the first place. You can see here the anchored VWAP aligning with 509. This comes from, by the way, when we first started to really accelerate. That was that gap up, recall. That's right there at the 509, reinforcing that level. If you really want, I'll throw a fib on here just for the sake of doing it from here to here. We have the bottom end of the balance range is kind of in between the 38.2 and the 50. The 61.8 is just north of the overhead supply 509 level. Fib's not really giving huge confluence with any of this. I would think that the horizontal levels really rule all. The logic behind that is just that people have positions, right? People have something to gain or lose based on what they've done inside of this range when we exit 522.50, when we exit 515. So throwing on an arbitrary fib in there, it doesn't really mean much to me when the levels are so well defined like they are in this NASDAQ channel. Let's take a look at the NASDAQ internals and see what's going on from this perspective. It's a rinse and repeat of the S&P analysis for the most part. You get mild inflows. Obviously on the Thursday session, I don't know if I would really count that as strong up volume. It's definitely not over 400 million. You get much closer to substantial volume outflows on Wednesday, Friday. You get closer to trend lower zone in the advanced decline line on Wednesday, Friday here as well, and much more of a neutralized build Tuesday, Wednesday. Friday's bearish, Thursday's mild. A little bit more indecisive, right? And I think that once again, this is sort of in service too, if we go back to the NASDAQ here, just the idea that we don't really have stronger buyers stepping up, and there was an attempt to break down from the range. The sellers tried to make a stand, no doubt. It's just not it's not going on. They don't have it going on there, those sellers, not in a strong sense, looking for that follow through. So I'd still be sort of neutral based on the market internals here, looking for the resolution of the range. If you really want like the bottom line on the internals, it's when and if we break this range and the market starts trying to hold over 522.50, the question becomes, do the market internals support that in real time? That's the question, right? As we're just dealing with this sideways chop and slop in the range, yeah, it's good to know that we don't have stronger sellers brewing some sort of bearish divergence in here, but what we care about is the confirmation from the market context when we try to exit the range, right? If you look at Thursday on the gap up open, just ask yourself the question on Thursday, did we really get confirmation? No, we immediately fell out of trend higher zone. The ticks on Thursday opened fairly firmly, but we're unable to really hold the zero line in a strong way. Notice that, yes, you get these lower wicks below. It looks like it's holding, but in reality, a stronger session is just going to produce, negative, not negative, but 500 tick off the open. That'll be the low tick for the first hour of the session or something like that. Hits the zero mark, bounces back again. Maybe there's an afternoon liquidation break, and then it's back here. It would have been a much stronger tick, and you just didn't see that out of the NASDAQ. So real-time confirmation is really what matters most there. Let's continue along to the market profile out of the NQ side of things. See what's happening from, we want to go. Where do we want to go? Why is it not? There we go. There's my button that I'm looking for. What do we have in terms of value? Value, just like the ES, kind of unchanged here. Big foray on that Thursday pre-market session. And here it is, right? On the Friday, when the market was breaking down, if value shifted lower, if point of control was lower, I'd be much more concerned, but it just didn't happen. It just didn't happen, and the market profile confirms that here as well. One thing that you might read into is just that the A-period single prints from the Thursday gap up, they're thin, right? So you could probably say Brigade Bolt over the top of the range targets that rotation. That's definitely a trade that's worth paying attention to. Back over to the QQQ, it's very simple. It's over the 522.50. Right, so balance rules in play until proven otherwise. You guys know my thoughts on the NASDAQ. Let's jump over, finish up the broad market with the IWM Russell 2000 small caps, see what's going on with the monthly time scale. And let's go clean drawing set. And here we go. Let's take a look. This one does require opening up a little bit more. There we go. So the idea here is candle structure and location. Let's go through it. We've got green-bodied bar, a little bit more of an upper wick than a lower wick, indicating some sell-side pressure near the highs. What I find a little bit more compelling is just the fact that the buyers were technically able to close outside of April's high. Bar-to-bar count does produce a higher low as well as a higher high. And what do we have relative to this? We did close above it on the monthly time scale, which I do like. Recall that the top end of this really, really brutal sideways range in here really wants to act as support if there are going to be any retests of that. I don't think that small caps can really afford to get back down underneath that level. Now, obviously here on the small caps, the overarching trend is not nearly as strong as what we have in the NASDAQ or the S&P 500. And I was listening to an interesting take on this the other day. Could it be because all of the new IPOs don't list as small cap companies and then graduate into the S&P and the NASDAQ, but rather they just list directly to the NASDAQ or the S&P 500? I mean, take CoreWeave, for example. You're not going to include CoreWeave in the Russell 2000 small caps. It's not going to happen. Reddit, what else recently? Robinhood. All of these newer IPOs basically go directly into the big dogs of the indices, not the small caps first. So is the growth story here dead in terms of you're not going to have these smaller companies that go on to become these behemoths, then graduate out of small caps, therefore you're not going to get the upside? Seems like that might be the way the new IPO market is sort of being facilitated, so to speak, for lack of a better term, to prevent small caps from really participating in some of the historic rallies that, air quotes, right? This is always, you think of this as the first to start the rally, the risk-on companies, and the first to fade the rally when the conditions really start to change, right? They're the most sensitive. So you're not really getting that out of small caps anymore, and that could be one of the reasons why. Back to the analysis of the candles in front of us, though. Close looks okay over the monthly 50, over the top of the range. We'll give the buyers the benefit of the doubt, but again, the trend here, the strength of the trend, not nearly as strong as the S&P and the NASDAQ. Let's drop it down to a weekly time scale, and let's take a look at this perspective. So you can see that the gap is already closed here. That happened actually last week. And now we just have a little inside bar. It's a bearish inverted hammer, red close, small body, and range overall was very small as well. The main thing that needs to happen here is this needs to sustain a hold at 200 for all the reasons we just talked about on the monthly, right? If you were to fall back down underneath that level inside of this range, I think you've sort of lost the point of the monthly, just consolidation at this point, right? If this is going to turn into a massive, monstrous, for the history books double top, first step to triggering the neckline is to get back down in this range, chop it around, and then this is sayonara for the Russell 2000 and small cap exposure, right? Now, again, we don't want to speculate on that. That's like many months in the making, if it even does happen in the first place, and it all happens, or the point of why we're bringing it up is because 200 is such a critical inflection point given these prior highs. If we go back down to the weekly timescale and bring out our anchored VWAPs, anything else we can learn about small caps, we're tangled up in the mess of the anchored VWAPs. I think I have to grab more years to correctly anchor previous high, previous low. Yes, I do. So we're tangled up in the mess of those anchored VWAPs as opposed to being above them like the S&P and the NASDAQ, which just continues to reinforce that small caps not really leading the charge anymore. You might want to take a little bit more of a neutral stance based on that. Obviously, if you were to break out through these highs from a trend count perspective over something like your 209s, 210s, you're probably going lows, soft weekly higher lows, firm weekly higher lows. Daily did pull back there. Over that, maybe 230s start to become a target. But the conversation just recenters around why would you try to get outperformance in small caps when we've clearly seen that they're underperforming on a relative basis, S&P and NASDAQ, right? If the market's going to make a run for it, you're probably going to get your true market leaders in the S&P and the NASDAQ also running with it, not necessarily some arbitrary outperformance from small caps because of the dynamic that we just described. So that's my take, at least. And small caps maybe losing some of their shine as a signal, so to speak, because of that logic. Let's go back down to the daily timescales here. Let's take a look at small caps from this point of view. We could throw the fibs on. I mean, obviously, if you were to come in from the last lower high, which was here, to here, you're at the 100% retracement, basically. As long as you're over this, you're good to go. That's that 200 figure. We could come in here from the bottom of the move up to the top of the move on the daily, over the fib 38.2, good to go. That's a little bit lower than the major lower high line in the SAN 198.25. For the most part, you're getting a similar story here, a similar picture out of the small caps where you're just consolidating sideways. If the stronger sellers were here, this should have yielded a lower high underneath, not attempted to get back in. I will give some credit where credit is due. Obviously, Friday's close is underneath 206, so it's not like the market just immediately accepted back inside of this range. It does seem like a look below successful failure from the buyers to keep it back in range. We'll see if that follows through. I would just, given the push and pull, I might keep an open mind. Maybe a more bearish edge here. First thought might be slightly more bearish in small caps versus the bullish thought first on the S&P and the NASDAQ. If we're under 206, bearish consolidation, this becomes the concern, right? You're probably looking underneath 203 to get to the test of the 200 figure, which FYI, I know we didn't start with the expected move, but lower edge of the weekly expected move, 200 flat. Very interesting how that worked out this week. That's precise to the number. And 210.14 on the upside. So equal highs and an equal low kind of keeps this as a neutral balance range. If you are going to play the game of the double top, things get dangerous underneath the 200, which, as we just talked about, is your red flag, white flag level from the higher time frames anyway. So I think it's very clear what needs to happen here in small caps. You either want to see for immediate improvement in the S&P, consolidation here and a possible breakout over 209.25. That opens the door, as we were just describing. 215, daily 200 SMA, and then the weekly has room into that 230, as we were talking about. If the market does start to fail under 206 and dribble down towards the neckline, I just think we think twice about how aggressive we are size-wise in the S&P. If you know the joke, you can leave it down below in the comments section. So that's the IWM daily. Let's go down to the hourly time scale here. Very, very neutral. I mean, look at the balance here, the foray to the downside. If sellers were going to step up, really Tuesday's open represented an ideal spot for drive to the downside, stay to the downside. Notice the lower wick on Tuesday's open doesn't really allow for that. Stronger sellers just not here. Now, we did dribble lower, and once again, I need to make the acknowledgement that we did close sub 206 on the weekly bar, but notice that it keeps getting bought up, right? It keeps getting bought up. So I would be open-minded to neutral to bearish first under 206, over 206 rock and roll in the S&P 500, under 203, you maybe think twice about the S&P. And that's kind of how I would simplify our IWM analysis as a bellwether gauge for the market, helping to drive some confluence and confidence in the decisions that we make. There we go, getting it out on a Saturday morning. Let's take a look at the Russell market internals. What do we have from this perspective? Okay volume inflows, just because of how strong things were on the Tuesday session. Really didn't get outflows or substantial outflows on the Wednesday or Friday sessions there, although we did close red on both. Not in trend lower zone here, nor on Friday, and the cumulative build probably outshadows to the upside on Tuesday, once again reinforcing that I probably take more of that neutral as opposed to outright bearish stance on small caps in this zone here. I think it's definitely not a bullish edge. I would really lean into the neutrality of this as opposed to the more bullish actions and thoughts that we've sort of set forth today in the other components of the broad market. Let's finish up with our small caps on the market profile. And what do we see here? Small caps absolutely loved the announcement of the blockage of the tariffs, and you could think about how that obviously impacts more of the smaller businesses than the larger cash, balance sheets that are flush with cash. You've got Microsoft, NVIDIA, the whole 9 yards. So all of that was taken back. I do think we have to acknowledge that failure, and again, I think we've done so by being a bit more neutral here as opposed to more bullish like we are on the other two. Value is progressively lower on the Russell as opposed to just more so flat. I mean, you get small downdraft here out of value. Nothing where I would be overly concerned about an Armageddon style trend developing. And even if you just analyze Friday's session in a vacuum, you've got poor high value area is in the upper half of the Friday session for the most part. Point of control absolutely is. Once again, stronger sellers just seemingly not flexing the muscle here, but not as bullish in small caps as we are in the other two. I think we've been pretty clear there. Let's jump on over to the platform here and take a look at the performance of our sectors and see what's going on from this perspective. So who was leading, who was losing, and where was the weight on the week? Real estate leads the pack here, up 181 basis points on the week, followed by staples, then the bond market here. You can see financials are the third in terms of sectors. That's up 1.04%, 104 basis points. At the bottom end of the barrel, you're getting energy, you're getting semiconductors and materials. Semiconductors down roughly 113 basis points, 1.13%. Not the worst posture in the world as the market goes sideways. I think the next big tell is if the market, again, keyword if the market breaks out of this range, what are the sectors that lead that breakout? So far, this continues to strike me as a rotational market, where as the market's consolidating and going sideways, tech is maybe taking a little bit of a breather, and as we can see at the top of the list, we're getting names like consumer staples, financials, even healthcare, not bad, up almost 1% on the week as it tries to resolve its balance range lows. UNH is still a train wreck, but it seems rotational to me, which is more indicative of a healthy market rather than a over-leveraged market, or you could think of it as an imbalance, right? If everybody's rushed into everything all at once, not good, right? It is sort of like a seesaw, teeter-totter back and forth. Let's take a look at the actual structure of these charts. Real estate, not much to comment on here, sideways in the range. New swing high, new swing low is where we care. Let's take a look at staples. Tried for a new swing high here into the Friday session. Once again, if the broad market was breaking out to new pivot highs as well, that would be a little bit of a white flag. The fact that the market was really just consolidating on that Friday session, S&P wise at least, not really the end of the world. Upward pressure, still upward pressure. Let's take a look at the bond market. Let's just go in order this session today. We've recaptured the 85 for you guys who've been following along. I do still have some short puts further out in June underneath the 70, it's really 78 strike. I buttoned up the 80 strike as this move has unfolded in the upward direction. Those short puts are, I think at this point, 75% plus credit received in profit. So it looks like those will not be assigned at a 5% yield, and we'll just take the credit received and rinse and repeat when and if it sets up again. If we look at financials, really sideways up here on the week, but what I like about it is the close. You could read this two ways, right? It's the close over 50.70, so buyers stepping up, continuing to, or notice that the lower wicks technically test underneath 50.70, stronger sellers not getting involved, not really trying to produce some sort of major lower high breakdown to get a test of the neckline, heck, even a weekly pullback to 48.65. It's just not happening. Financials are holding up seemingly well. If we look at the XLV, one of the things we talked about, I believe it was on Wednesday, is if we're looking for new highs in the S&P 500, you probably need performance out of healthcare towards the top end of the range, even though it's a defensive sector. Remember, it's the fourth heaviest weight sector. So healthcare performing well, financials performing well, and the tech sector performing well, that's your sort of key combination to be massively confident in the S&P breaking to a new high. If instead what's leading to a new high is consumer staples, healthcare, and then maybe something like materials, the lightest weight sector, then that's a pretty big white flag. Let's not chase the high in the S&P 500. Let's move along to discretionary. Nothing to really comment on over here, just a sideways balance range. Same commentary as the broad market itself. If the double top plays out, then sure, maybe it's bearish pressure for the S&P, but we have to break the neckline first. I'm not just willing to start accumulating shorts inside of this location, the range really, with basically what you're doing if you take that approach is you're playing the hope card, that you hope this breaks down, right? I would rather wait for the break to get into the range, start accumulating shorts here as a trade to close the gap, and then reassess at 203.90 in this case. So I don't see any issues with the XLY. If it was more aggressively, inverted hammer, bearish 3-bar play up against 210.25, maybe it would be a conversation point, but notice the hold, the Friday low of that 212.50. Moving along, utilities. Breakout here is offering the Brigade Bolt over 80.25. Once again, it would be a concern if the broad market was pushing to new highs, but it's not. It's consolidating, so rotation seems alive and well. The XLK tech sector, just like the QQQ, holding up over previous support lows here at 226.75. Consolidation in this range is bullish. I don't know how it couldn't be. If it is going to turn into a double top, that's fine. Once again, needs to break the neckline. When we get to 219, I would be thinking about weekly higher low. Why not? You have this gap fill reversal. You have the neckline of what could be construed as this sort of like loose inverted head and shoulders. I don't see the big bearish argument here for the broad market at this point. If we look at the communications sector, and again, big bearish argument, like, oh my God, market should be at zero. Could the market pull back and close the China gap? Sure, no problem. But I'm not, beyond the China gap, not seeing it. XLC. Communications look fine. Consolidation over this. So I could extend that off to the left. Great. This previous pivot high well above this 98.60s. I would think that this is bullish until proven otherwise. If we take a look at industrials, bullish until proven otherwise. Nothing wrong with that chart. Plenty of room for a higher low over 138.50. If we look at energy, what's going on with XLE? A little bit of weakness here. I think that we might read into this just twofold. If global demand is drying up, maybe the markets start to become more hyper-fixated on the R word. We could use crude for that. Remember, we've stayed over the 60 handle on crude over the last couple of weeks here. It's kind of important, this level. So if we could stay above, maybe this plays out as inverted. What is that? Let's not even assign a pattern to it. Let's just say higher low over this to bring in a higher high. You have thin structure retracement, which probably becomes interesting into these previous lows. If that breakout takes place, maybe it would suggest that yields start to move in the upward direction. Perhaps the recession narrative goes on the back burner, and it becomes more about how does the market contain the growth that is possibly going to push inflation higher, right? So higher rates might be something that the Fed looks at for that. So maybe watching crude a little bit. If it starts to break out here, I would maybe keep an open mind for some downward pressure in markets, but you could also just play it as the rebound trade, right? And okay, this is the avoidance of a recession moving back to here. So I could see it both sides out of energy. So back to the XLE as a chart, you're really just looking for the resolution of this zone here at 82.85. Failure so far to accept above. As we move into semiconductors, similar story to the QQQ and the XLK. Consolidation, acceptance, long lower wick on Friday, over the China gap, not getting into it, staying in the previous range. If it turns into a double top, that is fine. If we close the gap here, that is fine. My first thought is gap fill reversal, reevaluate at 237. If we get a lower high, okay, let's reassess our odds. Let's start thinking about the possibility of a trend reversal that's more substantial. Base case probably outlines that this would actually be the next move, though, with a higher low back over 237 after setting a weekly higher low on the China gap fill reversal. Let's move into the XLB and see what's going on from the materials perspective. Absolutely nothing. When it makes a new swing high or low, we will let you know. But for now, lightest weight sector, it's not going to move the needle. Let's take a look at our sector ratios and see what's going on from this perspective. If you're not familiar with this dashboard or how to set up ratios in general on Thinkorswim, check out the video tutorial top right-hand corner. Still looks like green shoots. The pullback's very mild here. Same thing happening in the discretionary sector. Financials would be great if they could get back up and over the 50 SMA, but I'm not going to call that a lost ship just yet. This is a non-issue because it's defensive. Defensive sectors outright, staples and utilities, not really breaking out in a big way over 50 SMAs. They're also pretty flat in there. So to me, this dashboard in isolation still looks like risk on. If we get into some more specialized ratios, You could see here, this still looks like risk on. This still looks like risk on until this really fails and brings in a major lower low under the 50 SMA. Risk on. Risk on here, risk on here. And again, it's like a total pullback. I will concede that point. Momentum has clearly slowed down. But is this an oh my god trend reversal driving to the center of the earth? No. So this also risk on ARC versus the S&P still looks good, as well as our more broad-based measure, which we just added last week. It's the Russell 2000 value, or I should say in order, growth versus value. Still in an uptrend here, signals that we have risk on as well in the more broad measure of the 2000 basket instead of just the S&P sectors relative to some other things in the S&P. Let's take a look at the basket B and see what's going on here. Gold ratio to the S&P still moving in the downward direction. No flight to safety happening there. TLT ratio to the S&P, small uptick happening here. But the main premise is that these style trends are really where the market's more comfortable, right? This kind of, oh my God, that's the issue we want to avoid. And the breakdown, this initiation of the downtrend again, that sort of has us covered in terms of risk appetite for equities being stronger than that for bonds as of right now. If we take a look at the Bitcoin chart, a little bit of a struggle, and we talked about this on Wednesday. It's sort of been a new silent high, new silent all-time high out of Bitcoin. You're not really seeing a lot of news about this in the headlines, social media, the whole 9 yards, which could be a good thing. It means that maybe there's the appropriate amount of liquidity out there in the market. Then you maybe look at something like the quantum computing space and you're like, okay, hang on a second, maybe there's still too much liquidity. The Sailor Shift tool is rotating to the downside. It's approaching the zero mark after back-to-back inverted hammers. I think if Bitcoin maybe pulls in here to the 92 handle, it would still be a long for a potential higher low. Now, if that does happen, it might signal in the short term, once again, risk off if Bitcoin's breaking down like that for the China gap close in the first place out of the two indices. This is, remember, one data point in the entire analysis we've conducted so far. Don't hang your hat on a Bitcoin pullback guaranteeing that the NASDAQ needs to close the China gap below. Let's take a look at some fundamental stuff like the dollar and interest rates. Dollar remains weak down here. And I think it's still the process of reshoring of other dollars going back home. You can see that interest rates did not break out over this handle nor the 48 mark. So this is 4.8 on the 10-year. If we go to a weekly chart view of that real quick, let's go to this chart spread here. So down below we have the 10-year on a weekly time scale. Remember that if the market's really going to be like, okay, rates are going to tighten the belt here and markets should really respond, it's got to be over 4.8 on the 10-year. That is, and you're just not getting that. So even with the credit downgrade that we experienced, it already feels like old news. It's just a nothing burger as long as rates remain sub 4.8 on the 10-year. If we look at what's going on with, let's go inverted ZT, the 2-year is a little bit lower here, which indicates that maybe the Fed's thinking about cutting rates. Let's just take a look at the Fed tracker tool and see what that has for us as we move over to it. Last week, we did get some important inflation and labor data, and honestly, nothing changed. Nothing changed out of the Fed tracker tool. Still 97.8% odds of a pause for the next meeting. That is, of course, on June 18th. Powell is speaking, by the way, as well on Monday at 1 o'clock Eastern time. We'll see if we can get live back up in the office for that. But 97.8% odds still, and about 2 rate cuts into the end of the year. As we know, multiple Fed speakers have come out and said that 1 is probably more appropriate, closer to post, I would say, September, once they have more information about the tariffs and the inflation or lack of inflation that they're going to cause. Speaking of, let's take a look at the jobs side of the market. Last week, we did see an uptick out of the continuing claims. That's in orange here. The initial claims are in blue here. And then in gray, which might be a little bit difficult to see, so I'll just move my drawings out of the way. Gray here is the 4-week unemployed number. You can see it's actually this. Can I open that in another tab? I can. Here it is, sort of moving in the upward direction. Not at a concerning point yet, but certainly the trend, the directional move in the 4-week claims average, it's not really what the Fed wants to see. Now, I'm not going to sit here and say like, okay, it's time to, can we go to 3, 5-year? Yeah. We're not like breaking out of this well-contained claims area. So I'm not here to say, okay, a recession is going to be on our doorstep and people are losing their jobs left and right. It's just a trend that we're starting to pay attention to. The continuing claims, a little elevated here, and a small uptick out of initial. If we look at the inflation metrics from last week, you can see here on the core and non-core, basically look at this column right here, we have really well-contained inflation. The PCE non-core, but still PCE at 2.1%, very close to the Fed's target of 2%. We also heard Jerome Powell bring back up FATE at one of his last conferences, which is flexible average inflation targeting. It means that over a span of many years, they're trying to target 2%. And if you recall, after the GFC, markets ran at, maybe 1.5% inflation, 1% inflation. It was very difficult for the Fed to stoke inflation. Even with rates at zero, they needed to turn the money printer on, right? We all know what went wrong with the sickness. That's fine. But the point is as we approach the 2%, the Fed might be open-minded to slightly over 2% to offset the years of inflation that was sub 2%. Just an idea, and it's not an original idea from me. It is just totally from the horse's mouth itself. Jerome Powell mentioned fate in his last conference. The other important thing that happened here was that the Michigan inflation expectations fell from the really astronomical read of 7.3% on the initial to still astronomical, but down 6.6%. The market sort of liked that around the 10 o'clock time frame on the Friday session. So speaking of PCE, inflation, the whole 9 yards, the big thing, I was finally able to find the proper chart. Remember on Friday morning, we were scrambling to find it. What we care about are these numbers here. Housing and utilities on the services side of inflation is the stickiest side of inflation. It also makes up roughly, it's not perfect, but roughly about half of the inflation metric, which makes sense. It's people's largest expense, right? So from a 0.5 to a 0.4, step in the right direction. It's still, if you're going to get inflation sub 2% on the core for Jerome Powell, then you're probably looking at requiring housing and utilities to come down to a series of 0.2s, maybe some 0.3s. We're just not there yet. But it is a step in the right direction, not moving against us to something like a 0.6, God forbid, like what we were dealing with over here when it was just inject in terms of cash into the market. So that was still the heels of it. Remember, this is January of 2024, not even that long ago. So that is what I care about in terms of parsing out the PCE report. As we look forward to this week, this is last week again, here you can see your inflation expectations falling dramatically. Let's take a look at this upcoming week. On the Monday session, we had ISM manufacturing PMI. Not really going to move the needle there. The market's really more concerned about services. We're a service-based economy. Here's Jerome Powell speaking at 1 o'clock, as we mentioned. We'll be live up here in the office at probably, maybe 12:50, maybe 12:45. We'll kick things off on the Monday session there to see what Jerome Powell has for us. We'll watch the live market reaction all together. JOLTS is going to be at the 10 o'clock time frame on Tuesday. Remember, it's a labor report week here. ADP non-farm on the Wednesday session, 8:15. That's our preview. On the Wednesday, we also get services PMI from ISM. That's the more market-moving one. And then you can see as we enter the end of the week, usual jobless claims. That's interesting. We'll watch out for it. But the market's really going to care mostly about this. It's the first major report post-tariffs that we'll have some decent data on. So unemployment rate, as we recall, the Fed is mostly concerned about a 4.4 on the unemployment rate. If we come in at a 4.4 or higher, Fed's going to have to respond. As of right now, the forecast is for a 4.2. And honestly, with the continued claims, it's been a little uptick here as we've seen. I wouldn't be shocked to see 4.2, 4.3. I would not forecast a 4.4 or above on the month-over-month unemployment rate here. As we move into earnings, the interesting takeaway now that NVIDIA has reported is just that you're continuing to see some downgrades here out of the revisions from analysts, basically, but it's really not, what would you say? It's not in the same way that we've seen this in the past. So typically, if you recall, through 2022, the downgrades, the revisions that were happening over here was because the Fed was tightening. We're actually about to head closer, or based on where we are currently in the cycle, the Fed is going to start easing. So these downgrades here really come more on the heels of the tariffs and the uncertainty that those pose. And I would think with the court action last week, we're getting, every day that passes and there's new stuff about tariffs, the market gets more tired of tariffs. I think you're going to get a market that just seeks clarity about what's the bottom line here? What's the end game on tariffs? Do we just wind up with 10% flatline across the board? Is the federal court going to block this stuff more? Or is it just not going to happen at all? And eventually, I think even the administration itself is going to have to sort of admit, not defeat in a sense, but just that this wild tariff plan, and I'll just use the China example, at 145%, it's not good for anybody, right? It's not good for us. It's not good for them. Tariffs, maybe if you want to use them as a negotiation tool, that's fine. Get people to the table to get other things that you want. But free trade is what serves the world the best. So that's my take here. Once tariff nonsense, the games that are being played, one day it's this, the next day it's that, the court blocks this, but hang on, we'll suspend it until this date, and then this and that. Once we're through this, I think these revisions snap right back up, and especially headed into an easing cycle, that'll act as a tailwind for equities in my view. The only way it wouldn't is if the tariffs end up doing so much economic damage in the short period of volatility that they've been in place so far, probably via supply chain disruptions, is if there's total demand destruction because prices are unreasonable, people start getting laid off, it hits corporate earnings. That's the worst case scenario. And as of right now, if we can just get through the next little bit till the end of the year for the Fed to start analyzing the data that's in hand, I think we dodged the bullet there. Let's take a look at the earnings calendar. This week, I would say some honorable mentions here to CrowdStrike, some honorable mentions to, who else is in here that's interesting? AVGO, Broadcom, there we go. That starts to get interesting. Oh, look at that, Lululemon. I'll say it correctly this time, not Lulumelon. Rubrik was also a pretty hot name in terms of a newer kid on the block last little bit. And I think that's it for me that I would be mostly interested in. MongoDB, maybe. Any SQL folks out there? I'm sure you're like, nope, stay away from that. All right, that's going to do it there. Just to sort of reiterate, this is some of the impulse that happened on Friday morning, stoking some more of those fears around the trade war, the China tweet, post, whatever you want to call it. This was released on Friday morning, you can see here. And what was recently released on Saturday morning is that tariffs on steel and aluminum are going to be brought from 25% doubled to 50% effective on Wednesday. I think the reason I'm bringing this up is simply to continue to reinforce to you as traders that short-term volatility, intraday volatility, little market panics and freakouts and this, that, the other thing, it's still top of mind. We're in a market that's still hyper-fixated on inflation and tariffs and the labor market. And with posts like this, you just have to stay nimble intraday. So again, the point here, it doesn't matter how you feel about tariffs, this, that, the other thing. It doesn't matter if you think they're good, bad, or whatever. I gave you my opinion just a moment ago when I was talking about reaching a free trade deal. That's my opinion. But as traders, right, we can all band together and I think reasonably say you need to continue to remain prepared and remain defensive enough for intraday volatility when things like this take place. That's the point, again, that it doesn't matter how you feel about it. As traders, you need to know that this is the environment that you're in right now. So with that, I think I will go back over to the platform here. We'll stop pontificating about the fundamentals and get more so into the technical indications as well. This going sideways, as we know, is decent as this moves higher. That's sort of an okay spot for the relationship of bonds to be. The issue sort of becomes when you would think if this is moving back in the upward direction, yikes, that would sort of signal that the Fed's going to hike rates again. That would be a bad idea. Not that it would be bad for markets, right? Markets wouldn't like that in terms of going up. Depends on your directional bias. But markets wouldn't like it. They'd go down. Let's take a look at credit spreads. Still pretty tame here after last week, remaining on lower highs. That's bullish for equity markets. If we take a look at the HYG in isolation, note the bullish divergence that's happening here still. You have lower highs in the S&P equities. This little double bottom here versus the lower low in the S&P equities market was righted. And who was correct? Once again, it was none other than the junk bond. So playing that out and continuing to watch that closely. Total breadth does not really look like an issue here. Small uptick this week as the consolidation persists. If it was a huge downtick during the consolidation, wow, oh my God, breadth divergence. It's not what we're dealing with. As we take a look at the RSP, you can see the same exact thing. If the RSP was still like down here or lower, even worse, on a new swing low, that would be an issue. But notice where the RSP is. It's right at the previous shelf. So no issues out of breadth there. NASDAQ equal weight is on par with the weighted index. We haven't looked at this chart in eons because it's practically useless at this point. If you've remained bearish because of the Dow theory, you've missed quite a substantial rally. Let's take a look at volatility. VIX rotating to the downside on Friday after PCE released. No issue on that. I think that you probably see a little bit of a build in volatility, maybe headed into the week, given the tweet on Saturday morning here about steel tariffs now doubled. You also probably see a little bit of a build around the labor report, I would think. And then maybe a crush on Friday, pending what the numbers actually look like. If the labor numbers come in really strong, let's just say a 4.2, right on the money with the expectation, I would think volatility crush and maybe a little bit of a pop here out of the market. Just noting that we're probably not headed to the recession narrative, but the Fed would stay higher for longer. So we take a look at VVIX just to get a little bit deeper into volatility, then we'll get the deepest in just a moment. No problem here underneath the 103 handle, and to finish it up, we've got our vol futures, which are still in a very strong contango, right? As I open this up, look at this push to new highs. The entire spread is still in contango now after a quick stay underneath on that Friday session there. As long as this is over the zero line, just remember that this really implies that money managers are more comfortable allocating capital in that environment. You could do the same thing here. 9 versus 30-day VIX is still over the zero mark. And if you look at the one-day VIX, it's finding a little bit more of a floor here. I think that that's reasonable considering the administration and the posts and the tweets that go out every now and then. The issue would just arise when and if there's an acceleration over 2145. We have not seen that as of right now. Let's take a look at the core list of companies and let's see what's going on from this perspective. And then 4 trade ideas I'll send you on your way. NVIDIA, what do we see out of NVDA? So just like the QQQ, here's your balance range. Overshoot on earnings. The gap fill reversal didn't really play off of 136.25. Doesn't mean we're throwing in the towel, oh my God, we're all bearish NVIDIA. It just means probably neutral through here until we can firmly Brigade bolt back out of it. What you'll find in the core list of companies here is that it's really a week to exercise some patience right off the open of the Monday session, of course. And then we'll sort of look to develop new theses. I don't know if that's the plural, but when and if we start to do something that looks like this, when and if we start to do something that looks like this, perhaps I would then change to bullish down here and then look for the recapture. Because remember, NVIDIA is still in an uptrend, absolutely. If you go to the daily time scale, right? I think it's worth noting, this is just a bull flag. The breakout, not really successful thus far. If we could get back over 136.25, it starts to resume. And even if we pull back over 129, remember on the daily time scale, we're still over the overhead supply low from in here, right? That's a major level at 129. So all set on NVIDIA. Concerns would increase on a Brigade bolt lower high under 129. It starts to close some of this thin structure, some of these gaps that still exist below us. It's not a base case situation, but 129 holds the key for it. Let's take a look at Microsoft. I'm really still not fond of this chart. If you've been tuning into the live streams in the morning, just really, I mean, garbage price action on the intraday, garbage action in here. So, and that's fine. Like the market's going to do what the market's going to do. We can't force our will upon the market. I think if Microsoft is going to offer a trade this week, it has to be consolidation here and a Brigade bolt over 462.65 for a quick date with the all-time high at 468.50s roughly. That trade is interesting to me. Anything other than that is really not interesting to me. Could you try to buy support here, right? Some sort of long off of this to this. You could try it, but it's not. To me, it's not a compelling trade to take. The market's been way too choppy for that. And thus, if I'm going to look for that next range expansion, you probably need that 462.65. Apple, another not interesting chart. If we look at this, here's a balance range. We've broken it out into thirds, basically, and they're all reasonable technical levels. It's not just random thirds, but it happens to be that way. You're trading in the lower third, which is maybe bearish. You've got a little bit of a hammer, look below and fail on the Thursday low from Friday. If you look at the price action intraday, it's another one of these names where if I'm going to trade it and be a bit more confident in the outcomes, I want this gap close overhead. That is a place where I'm willing to, put my capital on the line. Here's like one way to frame it is you work hard for your money, right? Why are you going to throw it away on garbage setups that are just like noodling around in a range? It doesn't make sense, right? So you would just wait patiently for the proper setup to give you the best chance of getting some return on your capital. So I'm really being patient on Apple. I have not traded this in the last number of weeks. It is not a name that has been a regular on my repertoire of active trades intraday. So it's continuing to be worth charting, right? It's a name that we should pay attention to, but it's just not setting up anything fruitful in the near term. I would think if you are going to trade the short side and you're trying to trade this as a lower high, I mean, Friday's response off of 197.35 isn't really what you would want to see as a short. Maybe 201 rejections give you something into the equal low, risk reward here for a scalp. I don't even really love that. I would prefer to see a breakdown of this here, and even at that you get I don't like it. So we're moving along. whenever I get that way, whenever I start like trying to justify different setups on a name like that, it's a huge red flag just to myself to, all right, settle down and move along, really. Amazon, another one. What's going on in this range? Absolutely nothing. So therefore, where do we have a better shot? Where do we have a better chance of getting return on our capital? Probably here. Show me the clearance of 206.50, or, right, you could actually tack on a Brigade bolt here as well to get the move over 208.65, the high of the Thursday session. If we could do that, maybe we rotate back up to this 213.25. The logic for that, I know it overshot here. It's really a more substantial level from back here, right? So the failure to accept above that then rotated to the downside, still 213.25. So that's Amazon. If we're really going to read into it, maybe the lack of gap close below is still a bullish indication, and stronger sellers aren't stepping up. But are buyers really momentum driving this to the upside? No. So patience until those levels break overhead. Google, another chart that's like, let's be patient in this range. Here's a range. Supportive off the lows, sure. 168.50s are acting as support, great. We've closed literally in the midpoint of the range. So unless you're already long from Friday's low, I wouldn't really execute new money ideas here. Maybe, because this is kind of a thin structure retracement overhead, maybe the Brigade bolt over 173.35. I would look to take profit aggressively at 176.75 if the move unfolds. And then beyond that, right, is really where it opens up. This is the better range to be trading for up here, right? 182.50 is that level. To the downside, if it rolls here, I would be patient for this short. And the short is something I would take if the broad market is also moving lower. Noting that we have thin structure out of Google. This was from the I.O. event, which was now just a couple of weeks ago, right? If we move along to the metaverse, a little bit more bullish here out of Meta. It's trying to respect some of the structure. It's not clean, but it's trying. We have previous balance trying to act as support. If we could stay above, I think that the rotations to the upside, sellers not really able to keep prices in range here. Next big outcome is some kind of Brigade bolt move over 646.50s, targeting the highs from Thursday's gap up open, 654.75, 661 is the ultimate target there. If we rotate to the downside, not interested in this range, not interested at all in shorts in that range. It would need to be this if I'm going to trade Meta shorts. And then at the gap fill reversal, right, it's right back to the long side. Let's take a look at Tesla. A little bit of an overshoot. Let's go to the daily chart here so we can start on this. The major reversal pattern is the double bottom. You could call this bull flag number 1. This is bull flag number 2. We are getting a little bit of a daily Brigade bolt here. I'm not in love with the heavy close on Friday, sub 349, back inside of the range, but I am willing to give it the benefit of the doubt where if Tesla opens on Monday over 349 and can hold it, right? Can we produce, some kind of inverted head and shoulders, and maybe it's even just triple bottom at that, but whatever. Can we hold 349 and rotate back into the highs? That would be the idea out of Tesla if it's going to hold 349. If we open sub 349, not interested in here at all. This, again, is just a range. I don't want to put my capital in harm's way trying to pull something, make something out of nothing, basically. If it was going to be clean, if it was going to be this nice move that we all were sort of hoping for, this needed to hold. And as of right now, looking a little shaky as of Friday's close. Let's move along to JP Morgan. Nothing to do or say about this in the range. If it is going to be inverted head and shoulders over the neckline, that would fuel the S&P higher. So for that reason, it's a top watch this week. Not really for a trade itself, but can this propel the broad market higher is the main idea. That would be over 266.50 into 270. Next up, Netflix all-time highs. Absolutely 1210, 1210 over 1210, blue sky territory, rock and roll. It's in a category of its own. It is in a category of its own. Look at this chart. Absolute monster. So that's it. I would not look to short Netflix here. It would need to be look above and fail in the range, and then under 1183 maybe, because we have this thin structure on the hourly, right? So look above, fail in the range, then this. Maybe that's a trade, but as of right now, Friday pretty strong, pushing those highs. Not a first thought. Let's jump into these 4 additional ideas, and then we'll wind it down for this weekend's episode. We've got, first up, we're going to go in order of most boring to most interesting. How about that? Walmart is up first. Pretty boring. What's going on with Wally World? We've got ourselves a cup and handle happening here. You could call it just a bull flag. It doesn't matter what you want to call it. If we can clear this 100 figure, we have a gap to close overhead. We do have relative strength via lows, higher lows, higher lows. As long as the consolidation remains, it remains in play. Brigade bolts here get very interesting. On the hourly time scale, you can see this. You've got your local highs, a little overshoot, and the bottom end of the overhead gap is technically $100.15. So I'd look to structure trades when we start to clear this or hold in here and then get over $100.15. That's the move here out of Walmart. Not interested if we start breaking underneath 96. That's your most boring name. It only gets better from here. Next up, Oracle. What's going on with Oracle? Larry Ellison, how are you? We've got a nice inverted head and shoulders, maybe even a inverted man ray pattern here with the double bottom at the bottom of the head, inverse. Here's his eyes. He's upside down, so his smile would technically be here. Let's take a look at the consolidation, right? Multiple bars over the daily 200 SMA over this pivot high, which is divergent and offering more relative strength than the broad market. If we can get a move in the upward direction, you have thin structure into the major high. Apologies for the arrow point, wrong area. Here at 173, a little bit of a hang up there, but if you look in the hourly time scale, right? Technically, that was a gap up open that failed. It's not like we had this big monstrous, like, oh, consolidation sideways for like weeks and then, another test and then lower. It was just one little gap up that failed. So beyond that, right, it sort of opens up into that 173. Going back to the hourly, you can already start to see the Brigade bolt that's happening here, holding over 165 is your next entry, looking for that upside to come into the 173. So Oracle, the next interesting bullish setup here for some upside. After Oracle, dialing it up, everybody's fan favorite, PLTR. Palantir, monster move on Friday. Obviously, there's that announcement about the contract with, was it Fannie Mae, Freddie Mac, all those, whatever the lenders are, right? Trying to eliminate fraud and waste. So interesting. The move on Friday, though, is most interesting because it totally blows out this consolidation here and offers very clean setups, like next steps. Very, very clean, right? If we get pullbacks, we're looking for holds of 127.15. If we could stay over this balance range, build a new stair step in the upward direction, great. Looking for longs here, retargeting the local high. If we get consolidation really high and tight over this, all-time high has to be the target. Blue sky territories beyond that. Very simple stuff. I think whatever was, inducing this large move, contracts or otherwise on Friday, has to be a top watch into the upcoming week, just given the amount of volatility and the interest in Palantir at this moment. So those are the levels that I'll be watching, primarily interested in longs up here, not really trying to fight the trend, and one of the darlings of the market right now, especially retail, making a boatload on this name. Lastly, CRWV, CRWV is the ticker on that one. Another new kid on the block, new IPO. Look at the parabolic move. At some point, right, we're going to look back at it and say, okay, it was due for one of these things, and then it, recovers in the future. But in the short term, notice that you have this little undercut of the Thursday, Thursday low. Let's take a look in the hourly time scale. You can see this real up close and personal. Here's your Friday low, right out of the 930 gates. Here's Thursday. This is Friday. Little overshoot, undercut. And then consolidation right back over this critical technical level at 107.50s. So this is setting up for a Stevie Wonder trade through the thin structure here. Anything on Monday over 111, I would think if the market's also producing bullish outcomes, 123.75 is a logical target here out of CRWV. So looking for some upside out of the new kid on the block. It's a momentum trader right now. It's slowing down a little bit up here, but the setup, the look below and fail on Friday, consolidation within, to me, is a little bit more of a positive indication. The other thing that's interesting about this is tariff agnostic, right? Because and you heard about this in the NVIDIA earnings call, right? NVIDIA is a huge investor in CRWV, and you could talk about, is that fraud, is it not, whatever. But I guess it doesn't, a venture arm of any company, like it's not fraud unless you're doing something fraudulent. You can invest in public companies. NVIDIA is going to be a buyer of CRWV, right? So in terms of like what's supporting this move, I think a number of different things. I think it's in the spotlight right now. I think it's got momentum. I think it's got all the things going for it. So possibly watching that 111 thin structure retracement to 123.75 makes good sense into the early stages of this week. If it's underneath, just kind of like letting it be, letting it do its thing. And I would not necessarily try to short this aggressively. Shorting parabolic movers, unless you've got the bankroll to do it and you're willing to take the paper cuts until it finally pays off, it's generally not a good strategy for most traders out there. So that is going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. You may or may not notice in the comments, in the description of the video, we're going to start rolling out the TB Live Squawk. It's going to be, some people call it live trading, some people call it Discord chat, whatever. It's a live voice chat in Discord. If you are interested in joining, there's maybe a link in the description if I have all my ducks in a row by the time this video posts. If not, I'll update it in post, so it is there at some point. It will certainly be ready by Sunday. And if you're interested, you can come hang out with us and hang out in the voice chat. If you're not interested, just understand that nothing changes about what we currently do. What we currently do, the Saturday videos, the Wednesday videos, the pre-market preps, all of that stays the same. This is not a reduction in any services. It's an addition of services based on highly requested, hey, can you stay live, right? Every morning on YouTube, hey, can you stay live? Can you stay live through the full session? Can you do this? Can you do that? We'll do it, right? But nothing is like, there's some compensation that needs to be made there. I'm not sacrificing my mornings to stay chained to the desk. If there's a day I don't want to trade, I would do this, that. You can join us if you'd like. The link may or may not be there by the time you're watching the video. And with that, I wish you good trading, obviously, this week as we head into the week. Maybe you'll be live with me. Maybe you won't. We'll see you in the office for our regularly scheduled pre-market prep on Monday morning, 8 o'clock. Again, that's not going anywhere. It's not changing. It's not getting cut early. None of that stuff. So that's it. All right. If you made it to the end of the video, I appreciate you. As always, have a green trading week, and I will see you in the next one.